Yeah, then welcome everyone. My name is Martin. I'm a mathematician by training and I have a background in quantitative finance. I'm also the founder of Morpher, and the goal of my company is to democratize trading and investing. And I want to talk about investing and finance today, about the industry and why it's broken and how we can fix it. So trading and investing, electronic trading especially, it's one of the biggest industries in the world, but nowadays it's very burdensome to participate, it's costly, and it's also very unfair for all participants. So everyone who was in the situation once already to maybe want to save some money knows that just leaving it in a bank account is not enough, because when the big expense comes that you're saving for, inflation has eaten it all up. So people turn to the capital markets. And here the game begins. So let's assume you have money or you want to save some money, invest some money. Then obviously the first party you need to go to is a bank. Then you need to go to a broker that provides you with access to capital markets that are usually listed on exchanges. Some of them are created by yet another company. Let's assume an index fund if you don't want to invest in an individual stock, but maybe in a basket of stocks to gain some level of diversification. You would buy an index fund that's issued by yet another entity. And in the end, you end up with your desired product. Let's assume in this case this is an ETF. So what you can see here is essentially that you have to go through 4 middlemen who stand between you and the product that you want to have, and who all charge you fees. And on top of that, they don't just charge fees, they can also default. And we've seen that in the financial crisis 2008, what happens if big counterparties default. But that's not everything. So that was the costly side of it and the burdensome side of it. Retail investors have another problem. They typically cannot short the markets easily. So when you're shorting a stock, you have to lend it from someone and you have to pay them a fee for borrowing it and buy it back later. This is only available to a certain extent and not to anyone generally, unfortunately. Retail investors have another big problem. They usually are very limited when it comes to the scope of investment instruments that they can select from. So commodities, for example, trade primarily via futures, and futures require a lot of capital to get started with. So if you want to participate in the crude oil market or in the gold market, what you typically would do is you would buy the future, the associated future. And the gold future, for example, has a notional capital, notional contract value of around $150,000, one contract for gold. And of course, retail investors are also limited to trading only during business hours. So 9 to 5, Monday to Friday. If Trump tweets something nasty about Tesla on a Sunday, you can only wait until the markets open again on Monday to react. Another big problem that both retail investors and institutions alike face and have in common is essentially the lack of liquidity on certain markets. This is true for pretty much any two-sided market that you will encounter ever in the world. Since we're on a finance conference, I believe most of you will be familiar with the order book or depth chart, but let's still talk quickly about what this means in practice. So this was, I think, the order book of Ethereum in a bit better days, a couple of months ago. And it traded at that point at 288.81. So traders, when they engage in trading Ethereum at that point, they assume that they can buy and sell Ethereum at that price. That's the last quoted price, right? Now, in fact, you can only trade a very, very tiny lot, a very tiny amount to exactly that last quoted price. You usually have to cross the spread. And this is what the red curve here represents. Yeah? If you want to buy up to 200 lots of Ethereum at that particular point in time, you will have to pay the last person that is willing to sell Ethereum at that point already $291. So that's quite far away from 288.81. This effect is called slippage, and we encounter it on any two-sided marketplace in the world. So this is true for every exchange, for every market. There are very, very few markets that are actually highly liquid, and that's a problem for institutional investors. All right. So the problems, to summarize it, you need to go through a middleman. This is expensive and burdensome. You don't get the level of liquidity that would be desirable on most markets. You have very limited access to most of the markets as a retail investor especially. And typically you have very high initial capital requirements. So you cannot easily trade fractional shares or fractional gold or oil contracts, for example, and you cannot short the markets easily. All right, so that's what's broken with trading, and I've experienced that myself, both as a small investor in high school when I bought US stocks for the first time, up to operating my own commodity trading advisor hedge fund in the US. So this is true for every market participant along the food chain. All right, and here's why it matters. This is actually a huge market that's fundamentally broken. It's one of the biggest markets in the world, or one of the biggest industries in the world. Trading and investing in the US alone generates, these middlemen in finance generate annual revenues in excess of $250 billion. So on a global scale, if we extrapolate that, that's $1 trillion industry in fees. And those fees are taken from the traders. They're taken from you. That's why it matters to reinvent this industry. And we have thought, let's maybe get started with the fundamental idea. Why do people trade? And if it's all that burdensome and all that costly and risky, why do people trade in the first place? Well, as mentioned initially, 95% of all trades happen because people are interested in financial gains, in the return of the market. And only 5% of all trades happen because people want to gain control of the underlying asset. So you might want to gain control of a stock, for example, if you want to have a say in the future of the company, if you want to attend meetings and vote. You might want to execute control if you want to get physical delivery of a commodity, as in crude oil. If you operate a refinery, you need your raw materials. Then you want control. But 95% of all trades happen purely for the returns. So if 95% of the traders trade only for, or the trades happen for returns, we can essentially fix investing and eliminate everything that's holding the industry back at the moment. We can easily eliminate that by virtualizing trading and investing on the blockchain. And this is what my company does. This is what our mission here at Morpher. We create a smart contract that observes all kinds of exchange-traded assets globally in real time, the price of these assets, and then replicates the economics of holding that asset on the blockchain. We issue our own native token, an ERC20 token on Ethereum, that can be used to place bets, to stake the token on any of the assets that we observe. So literally, in order to create an asset on our platform, all we need is a reliable data feed in real time with the pricing of the asset. Here's how it works for the investor. Let's assume you own 100 of our coins. You want to invest in the Apple stock. You stake these Apple stocks on Apple by simply placing an instruction to a piece of software, a smart contract in that case. And from now on, the smart contract keeps your stack proportional to the price development of the Apple stock. So simplified, that means if you invested 100 Morpher token on Apple and Apple goes up 10%, the smart contract creates 10 new token for you, and you end up having 110 token in the end when you redeem. In the other scenario, if the price of the market goes 10% against you, 10 of the token are burned, destroyed permanently, and you end up with 90 token. So this is exactly the same economics that you would get if you had bought Apple with dollars. If Apple goes up 10%, you end up having $110. In our case, the settlement currency is not dollars though, but it's our native token. So it virtualizes trading and investing. Through that, we get a couple of nice properties, and these properties together fix trading and investing for good. These properties are, there are no costs for trading whatsoever. You don't have to pay middlemen. You don't have to go through brokers or exchanges or index funds or any other kind of middleman in order to gain exposure to your market. Zero costs. You can trade global assets on one single platform, so this is a one-stop shop. You can trade commodities, cryptocurrencies, stocks, forex, and even exotic instruments that simply do not exist anywhere else. We could, for example, easily offer real estate prices in the inner city of London as a market on our platform. All we need is a reliable data feed. And thus, you can build up exposure in both directions to any market in the world, essentially. Yeah? With infinite liquidity, and that's also a first. on any two-sided marketplace, you need to find someone who is willing to sell you the asset if you are interested in buying it, and of course the other way around. Yeah? So you can only buy whatever someone else is willing to sell you. On our platform, every trade that you place gets filled immediately, regardless of its size or its direction. So this means effectively that you trade within our system with infinite liquidity. You don't have to wait for a counterparty. Another consequence of that is that we don't have slippage. Yeah? So what you see is what you get it at the price at which it is quoted right now, regardless of the lot size. And perhaps the biggest benefit of them all is that there is no counterparty anymore for trading. So when you buy a derivative contract or an option or something like that, yeah, you always have a counterparty, and that counterparty can default. In our case, the counterparty is a smart contract that's liquid by design. It's like a central bank that cannot go broke because it has the power to mint and burn currency. So there is no counterparty anymore. All right, unfortunately, I cannot show you a live demo of the platform. Internet connection doesn't permit that. But here's what it looks like today. We are currently live on the Ethereum testnet, and you can check it out if you want. You can give it a shot. We're at Morpher.com. And you can easily register and get 10,000 free token to play around with. So at the moment there is no real financial value behind this. But you can get an idea of what the platform will be like when it launches in the fourth quarter of this year. So essentially what you would get initially is this dashboard here. You have a watch list of markets that you're interested in. You follow their price. You see the leaderboard, so how well has everyone done in the last 24 hours in this case. And you can see with one view what your portfolio was doing. So these are the open positions that I have in this demo portfolio. Up here you can see the available cash and equity value, and of course equity curve over time. All right, now this would be the portfolio equity curve. Volatile of course. Bitcoin is a large percentage of this demo portfolio. So this is how well it has done in the last week. Buying and selling is actually super easy. You just go to the market that you're interested in, and you specify the amount of Morpher token that you want to allocate to that market. So there is no thinking in shares. You don't have to, if Apple trades at say $100, you don't have to put in 100 or a multiple of 100 in token here. You can trade Apple with one token if you want. It doesn't matter. You simply specify the amount of token that you want to allocate and peg to that market. You can do that both long and short. So you can also, without having to loan this lease the stock from someone, you can simply short it. Yeah? You can short any asset. It's exactly the same as going long, only in the other direction. So you benefit from falling prices instead of rising prices. As soon as you click execute that order, it is settled instantly as soon as the blockchain permits. And you can see the final price is usually the last quoted price as well, or pretty close to that. So this is really the last tick of that market. No slippage, no commission. And there you can see the open position, and of course it updates live, and you can see how well this trade has been doing. So that's in a nutshell how the platform works today. We have kind of a roadmap still ahead of us. In the fourth quarter of this year, we will do an airdrop. More on that a little later, but this will be our initial distribution model essentially. And then over time we will add, of course, new features to the platform. We will add mobile support, we will add leverage trading, new markets, and of course exotic markets that are simply not available anywhere else. You can trade corporate fundamentals, for example, on the platform. To the airdrop, we've chosen that as a model instead of doing a traditional ICO, because we're convinced that the value of every cryptocurrency, of every currency in the world for that matter, comes from its use. So the more distributed the token is, the more people participate in a network, the more valuable it is for everyone. And a good analogy, and I'm sure that most of you are familiar with that, a good analogy to that is Metcalfe's law. And that holds pretty well also empirically, at least in cryptocurrency networks. If you are the only person in the world with a telephone, it's quite useless. If there is another person, you can at least call them. If there are 5 people in the world with a telephone, yeah, you can talk to 4 more or 3 more in that case. And if everyone has a telephone, then it's valuable. Then it's really valuable for everyone. And Metcalfe's law also holds true for cryptocurrencies. This is also the reason why Bitcoin is still leading the markets by far, simply because it is the oldest and most mature and most distributed cryptocurrency. So it actually makes sense to launch crypto projects, in our opinion, by distributing the token for free to early adopters. And this is exactly what we are going to do with that airdrop. All right, so the question that we typically get is, if there are no fees for using the platform, how do you guys make money? And the answer to that is we do it the same way as other crypto protocols do it. Ethereum and Bitcoin mint new tokens as mining rewards through Coinbase transactions, and this is also what we are going to do. We mint 0.015% of the total token supply every day as revenue, as income for the company. To give you a benchmark, that compounds to roughly 5.63% inflation, as in new token created per year. And that's roughly equivalent with Ethereum's current inflation rate and slightly above Bitcoin's current inflation rate from Coinbase transactions. So every miner that creates and adds a new block to the chain is rewarded in the native currency, Bitcoin or Ethereum, and those new Bitcoin or Ethereum are created by the protocol. And we do exactly the same thing. So for operating the platform, we mint a tiny amount of token for the company. All right, the token economics, which is, I guess, also something that we're asked often, how does this actually work? Yeah? So how does this economy work stably? Our token economics have a few fundamental properties. The first property would be that the token supply is not constant. As I've mentioned in my example, the smart contract acts as the automatic counterparty to all the bets that are placed on a platform. So if you invest in Apple and Apple goes up 10%, then 10 new token, if you invested 100 initially, 10% or 10 new token are minted for you, as in newly created by the smart contract. In the other scenario, the smart contract would burn these tokens permanently. So that implies in a nutshell that the money supply within our economy is not constant. It's finite, but not constant. It depends on the collective success or failure of the traders on our platform. So if everyone is winning, then we will have more token in circulation. If everyone is losing, we will have less token in circulation. The second aspect is the token price itself is not pegged to a fiat currency like euro or the dollar or the pound. It's free floating. We treat it like any other currency in the world. So investing on Morpher, you can think of that as investing in a US stock if your own native currency is the euro or the pound. So you're essentially on top of the price risk of trading the underlying stock or whatever. You're also exposed to the volatility of the token. Token price is free floating, at least initially. We realized that this is something kind of a risk that not every investor is looking for or is comfortable with. And that's why we will offer products in about 1.5 years from now that will allow our traders and investors to hedge away the token price risk and build up fiat neutral, fiat stable positions, so to say. So token price neutral, fiat stable positions. But that's 1.5 years in the future. But we realized that this is something that people want, and they can then still trade within our platform without fees and with infinite liquidity, but be dollar stable and dollar neutral. And the third fundamental property, and that's more of an assumption that we have made, is that traders on our platform will be equally successful as they are on other platforms, on other exchanges. So that there is no systematic edge other than, of course, the advantages that we offer our traders for trading on our platform. Now, there's a couple of scenarios that we should think about. If traders are more successful on our platform, that means more tokens are generated, and that means that the money supply increases. Now, if traders are more successful on our platform than they are somewhere else, this is actually a very good business scenario for us because that's the jackpot. That means we have a smart community of traders that consistently and constantly beat the markets. So an easy product to build on top of that would be becoming the largest asset manager in the world by creating a hedge fund. Yeah, so even if that assumption does not hold in a positive sense, so if people are way more successful on our platform, that would open up the doors to a rather attractive product. If traders are less successful on our platform than they are anywhere else, that means that the token amount in circulation would actually decrease over time, and that would be a systematic, provided the same demand for it, that would be a systematic upwards driving force for the token price. So regardless of how this plays out, we're pretty much on the safe side here. Okay, the implications of these fundamentals is, what about inflation? So inflation, in this case, we refer to inflation not as a loss of buying power of the token, but an increase in money supply. So the number of token in circulation, refer to that as inflation. So how does this happen? How can this economy become stable if the token number is not constant? Yeah? We have to distinguish here between two different phases of our platform and our product. So the first phase will be the adoption phase. This is the phase in which more users will want to use the product than new tokens are generated per year. So let's assume everyone is super successful on our platform and everyone makes 15% or 20% per year. If we have a user growth of more than 20% per year, that means that in fact the token price macroeconomically should rise because there's more demand for the same finite supply of token. So that means in the adoption phase, which we would consider the first 10 years, of course, always under the assumption, provided that this platform is a product that people want, the user growth will outpace the growth through token creation by far. So this is not interesting. Yeah? In the adoption phase, inflation is not a problem. Interesting, it will become interesting in a steady state. So let's assume in 10 or 15 years from now, everyone who ever wanted to use the service is actually already active on the platform. So we've kind of reached a stable, steady state here. And we focus a lot on analyzing that steady state economy because it will be the economy in the long term. Yeah? So after 10 plus years, what happens? And we've actually researched that extensively, and I'm happy to provide you with an in-depth paper about that. That's beyond the scope of this talk to focus on everything, but I can give you pretty much the conclusion. So even in a steady state economy, without interfering into the economy at all, the top 50% of the traders, those who beat the inflation rate essentially, will manage to bank a financial profit, and the bottom 50% who don't beat the inflation rate will actually have a financial loss, even if their nominal token gain in a period is positive. All right, made simple again. The same holds true for currently existing markets. If you trade on a stock exchange and you make, say, 2% in a year, you have more money. But if the inflation rate in the same period was 3%, you have actually less buying power. So it's exactly the same effect that you have on traditional markets right now. You first have to beat the inflation rate in order to make a real financial gain. And that's also true on our platform. The second aspect to this is that we do have instruments to stabilize the inflation rate in the token economy. And that instrument is essentially burning a tiny fraction of token with every transaction. So that implicitly, that reduces the supply over time with every transaction. And we show in that paper that we essentially can reach every targeted inflation rate that we want to reach. If you want a 5% inflation rate, all we have to do is adjust the rate that we burn with every transaction accordingly, that we have precisely 5% in the end. So it will be possible to keep inflation at a reasonable level. That's the bottom line here, the gist of it. All right, since this is a high quality crowd at the DeFi Summit, I just want to mention quickly the implementation that we have chosen to do this. So we're obviously facing a tricky challenge here. We have to port prices of assets that are traded anywhere in the world in real time on the blockchain. So we do this through oracles, through oracle contracts. That essentially write these prices on request. So whenever a user wants to trade back on the blockchain. We will implement our set of smart contracts 2 times, one in identical sets, so to say. One time on the Ethereum blockchain and another time on a private proof of authority blockchain. It will be up to our users which one of the chains they want to use. Both of them offer individual advantages and disadvantages. Trading on Ethereum obviously has the advantage of all the trades happen on the main chain. It's super safe, it's super secure, it's transparent. So yeah, Ethereum, we benefit greatly from Ethereum's infrastructure and security. The disadvantages, however, of trading on Ethereum are that the trades are transparent, so everyone knows what you have been trading the moment you do it. The second thing is it's not really free because you have to pay gas for every transaction, Ethereum fees. And the third disadvantage in our view is that it takes at least 2 blocks to validate a trade, to confirm a trade ultimately. So we're talking of settlement times from in the range of a minute, half a minute to a minute, something like that. 2 blocks at least, probably 4. So it takes a minute before the trade goes through. On our private sidechain, we have the luxury of spending the gas for everyone because gas doesn't matter here. So essentially we host the infrastructure. The block time is also a second and not 15 seconds, so the trades settle instantly. Another benefit on top of that is that we can guarantee to a certain extent privacy of transactions on the sidechain. All right, now trust is always important, I realize that, especially in finance, and that's also why we have pegged our sidechain to the Ethereum main chain, essentially via the plasma scaling approach. It's inspired by plasma, it's not 100% plasma. But essentially what we do is we take a Merkle tree root of our sidechain positions, of the state of the sidechain, and write it on the main chain. So this way, even if you trade through our sidechain, you're guaranteed that even if the sidechain should stop operating, you can still retrieve your assets on the main chain without needing us. So this is a way of a trustless way to link to Ethereum compatible blockchains, and that's exactly what we're going to do. So this is the plasma scaling approach. I don't want to go into too many technical details at this point, but it's essentially just, you can think of ABCD as portfolios or the state of our users. We hash those states and then we build a Merkle tree, so essentially a tree of those hashes. And since hashing is quasi-unique, we will end up with a quasi-unique root hash of that tree. And from that tree that we write on the Ethereum main chain, we can then prove on the main chain, provided we know what B is. So the owner of the portfolio will be able to prove what their positions were, and thus they will be able to recreate their assets on the main chain without having to go through us, without having to trust us. All right, so this is in a nutshell what we built. Our goal is to democratize trading and investing. We want to give everyone in the world the same level of access to the markets that currently only institutional investors enjoy, without having to pay fees, being able to trade 24/7, being able to trade every asset in the world, being able to short it, and being able to trade with as little as $5 if you want and still have a perfectly allocated portfolio. So that's in a nutshell the value proposition. We're fortunate to be backed by Draper Associates. That's Tim Draper's venture fund, and we're also alumni of StartX. We are currently live on the Alpha platform. I can only invite you, please try it out if you're excited about zero fee and unlimited liquidity trading. Try it out. It's free. It will always be free. At the moment, it's paper trading only. We will do our airdrop in the 4th quarter of this year, and we want to distribute the first 10% of the total initial token supply to our first 10,000 users. So if you're interested in a token allocation that's going to be worth something between $100 and $500 probably, feel free to sign up, and then you're in line for our airdrop as well. Yeah, we really want to share this with our users and not sell the token to ICO investors who then in return sell it on the market and nobody actually uses it. All right, so that's in a nutshell everything about us. I say thanks a lot for your attention, and I'm open to questions. Do we need the microphone? Yeah, thank you.
Thanks. I think I'm quite confused by your token economics. Maybe I missed the point, but like, where is the money? Like, who's taking the other side of trades?
The smart contract.
Where's the money come from? Where are the profits coming from? Why does the token why should the token have any value at all?
You're betting against other traders for the percentage of the total pool money.
Yeah.
So which pool money?
The pool money that's issued initially. So we issue 1 billion of our token. Yeah. Let's assume they have a tiny fractional value, strictly above 0. If they have a positive value, it will be efficient for you as a trader to use our token to trade because you don't have to pay fees. You get infinite liquidity, regardless of the notional value of the token. Yeah. You get all the advantages, and thus the value is already created. Yeah. So that's the paradoxon of creating value. It's the same thing.
Where is the value created? Sorry, I'm missing the point. Like,
you have just basically something like Uniswap, right?
No.
No, because we do not engage in actually trading the underlying. This works like a future. We call it also virtual futures. Yeah. So for those of you who are familiar with futures trading,
I think the issue comes though at the start when there is like low liquidity and not many people using the platform.
It would still work.
Not if it's really one-sided though.
So how do I get the token in the first place? Let's start.
In the first place, you get it through an airdrop. Later, you can then buy and sell it like any other token through decentralized exchanges.
I get a free token.
You get free token initially.
And how do I make money out of it? I trade. There's an oracle that
exactly. You trade it.
Links it to Apple share price or Tesla share price.
Whatever you want. Yeah.
I get more or less tokens. But then, why are those tokens valuable at all? Like, how do I make?
Why is Bitcoin valuable? Why is Ethereum valuable?
Because it's traded at $10,000 and I can sell it for that.
Exactly, because it has utility.
Yeah. Well, I mean, okay, but yeah.
Every currency is worth.
It now for $10,000.
Yeah, correct.
Why should your token be worth any money? Like, what can I do with it?
You can trade with it.
It's speculation, right?
Yeah.
But I win more of it, or I lose a bit of it. But then, like, okay, where's my US dollar?
If it doesn't have any value for you, personally, it could well be that the token for you individually is worth 0.
Are you speculating that there will be a market where people will speculate that this token will have some US dollar value? Like,
the token will have a US dollar value when we launch, already from the very fact that people will want to have it.
You're betting against other traders, yeah?
Right, sorry, I think
you're not betting. That's the point. Then I don't understand. You're not betting against any other trading. He's just minting or burning token out of thin air.
Collectively,
like the central bank, like the Fed or the ECB. Why does the euro have any value? They mint. Yeah, correct. But it only has value because people associate value with it. And as soon as a value is associated with it, you can use it.
Yep.
You get more of the token.
Yep.
But with a relatively finite supply, all you're doing is you're increasing your percentage of ownership of the overall asset.
And then what?
That's it.
But there is no platform.
Why do you need the token?
What am I making out of it? I'm making more candies.
If you like betting against other traders.
No, you're not betting against other traders.
You're betting against everyone. You're betting against the smart contract and implicitly.
One question is, why does the token have value? And that doesn't need answering because it's the same reason as any other token has value. So let's leave that aside. And your second question is, where does my P&L come from? And your P&L comes from, either increasing or decreasing the money supply. So that also has a clear answer.
Sure, but the token there's 0 utility. What?
No, it has. This is an ingenious system. It has great utility.
Bitcoin has
as long as you want to participate in this game, then it's a utility.
But what do I need to put in DAI or ETH to get this token?
No. Initially, you get it via an airdrop, but if you want more, at some point,
it acquires value because you start using it. The moment you start using it, acquires value. If there will be more than 0 users.
Maybe I'm dreaming. I'll probably need to learn more about it. Anyways.
So there is no underlying asset, right?
There is no underlying asset and no underlying trading the asset. Yeah.
It's gambling.
Sorry,
where I'm winning the native token, but what do I do with it?
So I think you've shown like a really interesting use case of a token where you use the token to effectively act as an accounting system, and then as we discussed, right, somehow like the value of the token changes. What do you think of projects like Ampleforth that are doing similar things where you could effectively outsource like an Ampleforth style like token inflation or token, I guess like deflation model, and then just plug that into something like Morpher, where you're providing customers with real utility and a nice front end and a good trading experience, but you're outsourcing some of the thinking behind, I think, a lot of the token economics we're discussing to another company like Ampleforth.
Yeah, right. So to be honest, I'm not 100% familiar with what Ampleforth offers or provides. We have looked at the space extensively, and we came to the conclusion that what's really unique here is, and what's also valuable for people, what's our value proposition, is that there is effectively no counterparty and that there is no trading the underlying. Those are the two big things that hold all these virtual trading platforms back. Many of them, just throwing it out there, Abra, for example, they actually engage in trading the underlying. Abra is nothing else but a CFD on the blockchain. Then there are other projects like MakerDAO or Synthetics. They really try to replicate it by crypto collaterals and all of that. That's all nice and fine. But in all these cases, you typically have a counterparty. You need someone else on the other side, and that's in our case. It's not the case. You just place an instruction to a piece of software. You're betting with the central bank, essentially, and the central bank increases or decreases money supply. So we think of our system as pretty much closed in itself. And that's why we haven't looked yet at outsourcing aspects of it.
But I'm sorry, I challenge that you don't have a counterparty. Every other participant is
indirectly.
A counterparty.
Yeah, indirectly.
Because if you burn some tokens that you have, you now have a small percentage of the overall pool.
Yeah.
If you mint some, you have now a bigger percentage of a slightly increased pool. So your counterparty is the entire community that participates. So
that is correct.
Gambling site.
If you will.
But you've taken it to the extreme. You said, look, traders are simply gamblers. Let's remove the bullshit that they give a shit about the underlying. And all we're doing is just letting you gamble, and you need a agreeable source of data as to which where you gamble. It could be soccer scores, it could be price of apples, it could be price of sneakers or anything else.
Exactly, yeah.
And you just go ahead and gamble, and if you like gambling and want there is value in that too.
Yeah, correct.
Well,
okay, a microphone, please.
I understand you're centralizing all onto this one token as kind of the house token.
Yeah,
but then surely, if you want to scale and compete with a kind of a national stock exchange, then if there's going to be like 500 billion of notional value of equities traded on your platform, if they're settled on if that amount of that value is settled on a particular day, there has to be that amount of liquidity in your token if people want to convert back to US dollars or Bitcoin or something. So you're reliant on your token becoming as liquid as all of the liquidity on your platform, which is quite a big ask, because people don't want to be then gambling. They might have like 20% slippage on your token when they've had a really good trade and a winning trade at 5%, and I lose it on 20% slippage on your token.
Not internally, but externally, for converting the token back to fiat.
To actually realise, if I want to then flip out their token,
that is correct.
I'm relying on the underlying liquidity.
And that's why network effects are key here. The economy has to grow big enough, that people are willing to trade the token on a secondary exchange. We are, by the way, also willing to build our own fiat on and off ramps over time. So we become counterparty for that token.
So I have a question about the actual price. I have a question about the price misalignment from, like, when you have a feed, obviously this is the price of the stock with the assumption that it is pre-dividend, post-dividend, and so on. And obviously you're not actually trading underlying with some kind of bet on it. So how do you think will look this misalignment between your platform and the actual prices that are coming in the feeds? How you reflect it? You just expect the market to adjust?
No, it's absolutely vital that there is no mismatch between the real market price and our data feed. So we actually get the data feed from brokers, from data vendors, from the markets themselves. So we observe in real time what happens on those markets. And yes, we have to observe not only one source, but multiple sources in real time and consolidate the price to get a ground truth for that market on our platform. That's one of the technical challenges that we have to solve. But
it's more of a question. It's like, because you'll have just post dividend, you'll have a drop in price automatically on stock, but there's no dividend on your platform, right? So
we will have splits, we will have dividends, everything.
No, you trade the adjusted price. You don't trade
correct.
The price.
Okay. Yes, you wanted to ask a question a while ago.
So it seems that you don't use any asset. Sorry, you are using Ethereum, but you don't use any Ethereum asset.
That's correct. Yeah, we use Ethereum.
Token.
Yeah.
Why did you choose Ethereum then? I mean, it's not very efficient for what you are doing.
I cannot mint and burn Ethereum.
Sorry?
I cannot mint and burn Ethereum.
But it's a far more liquid token, so actually probably
But again, I cannot settle your trade in Ethereum because I cannot create Ethereum out of thin air.
No. That wasn't the question. The question is why are you using Ethereum blockchain?
As a protocol.
As a protocol,
yes,
in order
it's
to
very inefficient for what are you doing.
No, it's not. We benefit greatly from the security that Ethereum provides.
Yeah, but you could like create the same network, the whole thing. Like
yeah, we could.
In the Cosmos, for example.
Sure. Yeah, absolutely.
Or a Polkadot system.
Absolutely. So there are a couple of contenders that we could have chosen. We have also looked at others, but we ended up going for Ethereum because it has the best developer community still, in our opinion, and. Going forward, it is still the second biggest currency at the moment, and it has an ambitious roadmap.
By 10 transactions per second.
No, we're not.
Off-chain.
Off-chain, we're not. We have thousands of transactions per second throughput.
Or off-chain.
You can choose. If you want to trade on-chain and compete with CryptoKitties for performance on Ethereum, then go for it, We offer you that option as well. But if you want it free and instantly settled, then you use our sidechain.
For example, using Cosmos?
We have considered many protocols, we've looked also at Cosmos, we have looked at EOS, we are also looking at Cardano, but at the moment none of the other projects has the maturity that we need, I'm happy to, if I've missed some insights, then feel free to point me to them afterwards, I'm happy to consider it,
Yeah, so, like personally I would be a user of this today, but one thing that it's missing is, as you mentioned, the hedging of your risk to Morpher. And you said, you'll offer that in a year and a half, but I'm not really clear why, because it seems you can just, make that just another, bet that you're, on your platform.
Yeah, correct. And this is the internal way of doing it. So we could hypothetically offer a Morpher token market, and you could just short the Morpher token, and then if Morpher goes down, you get more Morpher token. The thing is that this is an edge case in which our economy could spiral out of control, either up or down. So this could trigger a hyperinflation or a hyperdeflation. If a significant percentage of users on our platform does that, then if the token price falls, we mint new token, more token for all these users who are short, more, and hyperinflation or hyperdeflation in the other scenario. So that's why we have chosen, we will do a more conservative approach with external instruments that we will offer and provide to hedge against the token risk. For this, we will need a secondary market already. And this, you can think of that then as a future that you enter into more for short, then it's fiat stable and you can trade with infinite liquidity on our platform, and when you cash out, you get the dollar amount that you have put in.
So, do you have a gambling license for this platform?
No.
It is.
No.
I mean, I know you can dress it up, but this is gambling. There's no underlying.
Yeah, every stock investment is gambling to a certain extent. Yeah. So no, it's a good point. Yeah, we're working with a lot of very good law firms here in Europe, and we know exactly how we are classified.
And how you also, because this could be considered as a derivatives on crypto, so the SEC has already ruled that that's not allowed, or a gambling site. So where are you
Correct.
on that spectrum?
Let's not talk about the SEC. That's beyond the scope of this talk. Yeah, let's talk about Europe. We are launching we're launching here in Europe, and Europe has a nice framework of regulations. That's MiFID II, and you're either a future or a CFD or something else under MiFID II. Then you have to get the proper license, or you are not. Yeah. And all these financial instruments, so without talking now too much about the legal side of things, but all financial instruments have one thing in common, or all exchanges have one thing in common. It's always a marketplace between two parties. There is a counterparty that benefits directly from your gain or your loss in that case. Yeah. In our case, the money doesn't change hands. It's always in your wallet or on a sidechain in your wallet. You don't trade with anyone else on the platform. And there is no counterparty. We do not benefit directly from your gain or your loss. So we are also not a CFD shop that wants to knock you out. Yeah, we don't care. For all we care, we're happy if you win. Yeah, because that's a success story from a customer that will bring us many more customers.
But your contract is a central counterparty, so you're novating trades effectively.
The counterparty is a piece of software, a central bank, a virtual central bank. Yeah.
But you write that software.
Sorry, say again?
You write that software.
Yeah.
You know they'll get you eventually. I mean, I know arbitrage, but within a year or so.
Yeah, maybe there will be a Lex Morpher at some point. I'm looking forward to that.
So I've got a slightly different question about Oracle. So when markets are closed, like a weekend, how do you get the price? How does the Oracle get the price?
Yeah, that's a good question. So we essentially rely on that on OTC feeds. That's the best data that's available at this point. But yeah, there is some complexity in that, and an OTC tick that consists of an odd lot or with a small volume, with one word, will probably not be represented on our platform as a price jump, only if it comes with meaningful volume. Yeah. So there are over-the-counter trades that happen also on the weekends when exchanges are closed, and we use that information if it's available to us for pricing it. Okay, one more question, then you can. I'm happy to answer questions individually afterwards.
That was maybe a simpler question. You mentioned the infrastructure for the POA network with 1 second. So what are you running this infrastructure on, and what's the POA protocol that you use?
Yeah, we have written everything ourselves. It's essentially Ethereum. Yeah, Ethereum.
I mean, specifically, is it like your own consensus, or is it Click or Aura? Or
yeah, it's POA. It's proof of authority consensus. Yeah. So you only have a limited number of nodes that are allowed to mint blocks, and if you operate them all within a very fast network that can talk well with each other, the nodes, then it's pretty fast. You can get it to 2 seconds or to 1 second.
Is it running on Parity or Geth or?
Yes, we're running on Parity.
On Parity. So is it Aura, right?
Sorry?
Is it Aura?
Good question. Yeah, I assume.
Okay, so
we host it generally. Our hosting provider is AWS, just a server provider, and then we use Parity and we configure a POA chain. Yeah, that's essentially it. And this could operate hypothetically. We don't do it, but we could operate it with one node, so trivial consensus. Yeah, so that's why we could get a high throughput, because only on the sidechain only we are allowed to add blocks to the chain. There is no proof of work consensus, and that's why it's fast and scalable. All right, thanks everyone. I will be outside.